Kind of start right there, that the Fed repricing, Ben, it seems like it really has overshadowed sort of the whole optimism around China reopening, the like here. How do you approach risk moving forward now?
Yeah, good morning. Great to be with you. I think that's right. The Fed is clear that inflation is too high. So I think we've all been a little bit excited, perhaps excessively so, that inflation was coming down. But sadly, in the last couple of weeks, a couple of things have happened. Firstly, it's become clearer that inflation is not coming down as quickly as we all might hope. And I think the Fed, even yesterday, our time, reminded us that they have a mandate, right? Mandate means mandatory. They can't pick and choose, and their mandate is to get it down to 2%, and that might mean higher rates. And that's why one of the key reasons why we at the BlackRock Investment Institute are underweight DM equities, as that's going to be a headwind for risk in our view.
Ben, the thing is there a recognition, and I don't know if you see it, that actually inflation and the very beast that it is has changed, or is changing, I should say, structurally, given that we've got this shift to green energy, we've got demographic challenges. On top of that, there's a change in globalization here as well, and that could well mean that inflation will be sticky looking ahead.
I think, Rishi, raised maybe the critical point, which this is a world shaped by supply. So this is a fundamental change from the era that we recall fondly as the Great Moderation over the last 30 or 40 years, where supply was kind of no problem. Maybe that was the internet, maybe it was the Chinese labor force, WTO, all of that. But we've clearly pivoted to a world where supply is a big problem, and I think we can say that quite clearly because inflation is high. That's the outcome. And those supply issues, some of them are receding with COVID, hopefully becoming more and more historic kind of thing, at least from an economic perspective.
Ben.
But some of them are not. And I think the concern we've got... Sorry, Rishi, please.
And I just wanted to interrupt. I just wanted to ask you, so are you saying at the moment there's been, in essence, a change from a deficiency in aggregate demand to one where we're getting a deficiency in aggregate supply, and that's one is not being recognised properly?
Yeah, that's right. So that's the BlackRock Investment Institute. I guess you can summarize a lot of our thinking and work in exactly how you've just laid it out, Rish. It's a world shaped by supply. That's fundamentally different from the world where demand was only the really question, supply being no problem. That has important implications for how we should think about risk, portfolio construction, and life more generally. The big point being, sorry for this, but it's going to be harder because inflation has gone from being no problem to a big problem. So that means as a central banker, you have to go from just managing demand to managing both demand and thinking about supply now binding, creating this inflation total change in paradigm. Again, inflation moving from loosely, let's call it no problem, to a big problem. I know we all know that, but I think it's unlikely that all of the implications have fully fed through, and that's something we're talking and thinking about a lot at the BlackRock Investment Institute.
Ben, David here. Does that mean, I guess, comparing what this coming decade might look like compared to the last one, in terms of average, I don't know, annual investment returns, are we likely looking at lower returns this next 10 years then because of higher yields, higher rates, what have you?
So where I would say that, David, is actually it should be a riskier world, right? In a mathematical sense, that means the tails should be fatter, and we're all going to be wrong a bit more often. That's not an implied insult to anyone. That's just the math. If things are more volatile and riskier, then we should be less certain going forward. So in terms of portfolio construction, we think two things. One, we should be a bit more dynamic. We might need to make more choices a bit more often because markets are going to be more volatile, reflecting that more volatile macroeconomic backdrop. And two, we probably need to be more granular. We can't just be levered long everything. The everything bull market, sadly, is over. So we're going to have to be a bit more specific in where we're investing, both by geography and asset class. So it's a slightly harder work, I think, for all of us, more dynamic and more specific in terms of our investment frame and portfolio construction from here.